Leveraged ETFs are great for traders. They give you a huge potential return, but they come with a lot of risk. In this video, I'm going to show you a back-tested trading strategy that shows you how you can reduce your risk, maximize your potential return, and most importantly, free up your capital. I want to start by looking at FAS, which is the Leveraged Financials ETF, and I'm going to direct your attention to the key metric for this analysis. Compound annual growth rate adjusted by percentage time in the market. Now this is a simple metric. It is compound annual growth rate divided by percentage time in the market. Now what this gives us is an adjustment for how much or how little the strategy is invested. If it's invested more, you have more capital tied up and you're exposed to more market risk. If it is invested less, you have less capital tied up, in other words, more capital for other trading strategies and less risk. So we want this to be as high as possible. Now you can see on this basic setup, we have FAS perform very nicely in this trading strategy. We're using a long-term stochastic look back period of 75. We're using a entry filter, so it must be below 50. But you can of course adjust this and you'll get different results. I'm going to keep it at 50 for now, and I'm using the Bollinger Band width of 2. So I'm using a standard setup here. Now the only thing I am going to adjust is the exits, because it is the exits that make the difference in your trading. Now I'm using a thing that I describe as the strength close. This is a really easy concept but very powerful, because it allows you to exit positions when the market is exuberant in the direction of your trades. So 2 consecutive bars of at least 3%. Now I'm going to highlight this. Now this is crucial for the strength close. 2 consecutive bars of at least 3%. So we're exiting when the market has moved strongly in the direction of the trade. We've got 2 of them here. One of them, we can adjust them separately. One of them is when the trade is in profit, and one of them is when the trade is currently in a loss. With FAS, I am saying 2 bars of 3%. However, you can see when I adjust these to 1, in real time, everything has adjusted. We're still sloping upwards. Our overall net profit is lower, and our compound annual growth rate is lower. However, our compound annual growth rate adjusted by percentage time in the market is higher. But how could that be? Because we have such a low percentage time in the market, only 5% of days. So 5% of days we can get all of these gains. That means your capital is free to trade other strategies, other leveraged ETFs, and look for the best possible opportunities. This is the sniper idea of trading, of finding the best trades. These are volatile, risky trades and exiting quickly with a profit. Next up is the TQQQ, which is the leverage version of the QQQ, which tracks the NASDAQ 100. And I am using exactly the same entry conditions as before. 75 period stochastic, 50 entry filter, and 2 for the Bollinger Band. The only difference is the exit conditions. So I've set these to 2 bars, the strength close to 2 bars of at least 6%, and they have to be consecutive. And we have a good net profit, high profit factor, compound annual growth rate adjusted by percentage time in the market, 35%. Now, let's see what happens if I adjust the strength close to just 1 bar. You can see here, we're now only in the market on 19% of time, freeing up your capital. Compound annual growth rate adjusted by percentage time, 53%. Now, if I was to change this to 5%, compound annual growth rate adjusted by percentage time in the market is 80%, because we're only in the market on 13% of days. I could adjust it again to 85%. Now this is a balancing act. You want to get the performance that is appropriate. But here we're only in the market on 5% of days. Next up is SPXL. This is the leveraged, the 3x version of the ETF tracking the S&P 500. You can see once again we have an upwardly sloping capital graph and we have exactly the same entry conditions. The only thing I am adjusting is the exit conditions. You can see if I change the strength close to just one bar here, this metric increases again and we maintain our upwardly sloping graph. Our percentage time in the market is lower. So we have a less risk because we're exposed on fewer days. We're exiting with a profit, ideally as quickly as possible. We can reduce our risk in other ways as well. We can tighten up the stop loss. You can see here, we can get this here, so you get the appropriate levels of risk that you want to accept. If you've enjoyed this video, please hit the like button. Please subscribe to this channel for loads more content like this about technical indicators, about backtesting and developing trading strategies. And for more information about trading the financial markets, please go to tradeinformed.com.